Let's check out shares of TD. They're actually recovering today. Now, yesterday, when the company unexpectedly reported an increase in profit, better than expected results generally across the board, we saw the stock sell off. There were those concerns about how much is anti-money laundering issues going to cost the business, not just in fines, but in expense growth. It's one of the reasons that the stock fell yesterday, and analysts downgraded it to underperform. Today, though, we are seeing a recovery. I've got an analyst on deck with me right now who's also pretty bearish on the prospects for TD. Let's bring in Nigel D'Souza, financial services analyst at Veritas. Thanks so much for joining me.
Yeah, thanks for having me.
The source of your bearishness, is it largely the AML issues?
It is because, when you think about the monetary and non-monetary side of this, the monetary side is not the area of concern. TD has close to $5 billion in excess capital. We think the fine will be probably around US $2 billion, but they can absorb that. They can digest the cost of the fine. The issue is the other side, the non-monetary penalties that may come through. That could restrict asset growth. It could limit new business activities, including new branch openings. It could also prevent TD from acquiring other assets. So there is a risk here to the outlook for earnings growth for TD's U.S. franchise. And that's on top of a challenging industry for U.S. banking where cost of funding is going up, non-interest-bearing deposit balances are declining. Banks have to pay more to retain the deposits they do have. And even when they do pay more, deposits sometimes still leave to higher yielding alternatives like money market funds. So it's not a constructive backdrop for U.S. banking, and this issue is not going to go away anytime soon. Any non-monetary penalties or a cease and desist order, we think will take at least 3 years, potentially 5 years or more to resolve. And until that goes away, it's tough to be positive.
The question is that already baked into the stock?
I think it is discounted. There's no question that TD is trading below its historical valuation. The issue is that without getting more clarity on the outlook for earnings, it's hard to start as an analyst determine what is priced in and what is over discounted. And until we are aware and TD discloses what the monetary and non-monetary penalties are, it's difficult to game out the trajectory for earnings growth. And without having more clarity in earnings, it's difficult to justify what the price should be. So
I spoke with a shareholder who looked at it in two ways. One, they get the monetary penalty. They can absorb it easily. They've got high capital levels. The two is they get the penalty plus they have a consent order. Well, then they just have all this capital still, and they just use it to buy back stock, maybe sell down a little bit more of their Schwab holding. That this is the bank, at least from a balance sheet perspective, can absorb it and do something about it.
So when we think about the excess capital, close to $5 billion, assume a fine of $2 billion, and we're right on that. That's going to eat up half of that capital. And then if you look at the remaining buyback program, they can buy back an additional 32 million shares. That's another $2.5 billion. So that excess capital that TD Bank has, that could go away pretty quickly after it completes its buyback program and after we have the monetary penalty. And then it's no different than any other bank in the space operating at a ratio of capital around 12.5% to 13%. So the buybacks, that's a 1% to 2% benefit from a reduction in shares outstanding, but it's not enough to outweigh the long-term headwind from a cease and desist order by the regulator in the U.S., especially if there's opportunities for organic growth or for market share gains. TD can't participate. So that really is going to handcuff the U.S. franchise at least for 3 to 5 years.
So the organic growth issue is a concern. I guess I'm trying to understand, Royals moving towards highs, National's moving towards highs, JP Morgan's moving towards all-time, Bank of America. So all bank stocks, notwithstanding your comment about maybe the outlook is a little clouded, but they're all doing just fine. Operationally, TD seems to be doing just fine. This penalty just seems so severe on the company, where we know from a balance sheet perspective, they'll be able to handle it. It won't be pleasant, but they'll be able to handle it. And the rest of the business is doing just fine.
So I think that's an important point, and we need to deconstruct why the results were good this quarter. And the upside surprise was driven almost entirely by their capital markets business and their wealth management business. So that's a function of very accommodative and supportive financial market conditions. That could change. We don't know. We can't predict that. But that's not a reliable recurring stream of their core earnings. And the market may not necessarily reward banks that beat earning expectations purely on capital markets and wealth management. especially when the underlying trends for personal and commercial banking are unfavorable at the moment, where you have net interest margin contraction and credit losses continuing to move higher. So if we go through next week and we have beats, which are more likely now given TD's results, based on capital markets and wealth doing better, but the Canadian or international banking franchise are faring poorer because margins are contracting.
Canadian bank, wasn't it good?
Well, the margins didn't expand.
The margins didn't expand.
It could have a good quarter, but the outlook for margins, and TD expects margin contraction now in Canada. So.
Okay, so what is, outside of the AML issues, what does TD tell you about what we're likely to see from the rest of the Canadian banks? It sounds like good capital markets, but margin expansion is sort of an outstanding question, might be bank specific.
So I think if the strong results for capital markets and wealth management carries over to the rest of the banks, you're going to see more likely than not beats next week, unless we get one-off surprises, either higher credit loss provisions than expected or other items that are more difficult to predict. The bigger issue is that if all banks also reflect the trends for TD, which is margin contraction in U.S. banking and limited or no margin expansion in Canadian banking, and credit losses are continuing to move higher, you may not see a positive reaction by the market because it's going to look ahead to weakness, and it may not necessarily bank on financial market conditions remaining supportive.
You have a seller reduce on all the Canadian banks except one, Canadian Western Bank.
Yeah.
What do you like?
It's discounted pretty substantially. It's trading below book value. And the difference between Canadian Western Bank and other banks that are discounted, like a Scotia or TD, is there aren't bank-specific risks for Canadian Western Bank, like a transition to a new CEO or a new strategic plan or AML or regulatory issues. So with CWB, historically, they've done better on credit losses through the cycle. They are typically stable on net interest margins, so they should be able to perform fairly well as we move through this. And it's one of the only banks in the space that I think is trading at a significant discount without a specific identifiable risk that would justify that discount.
All right, thank